Hello, everyone. Welcome to the BDO Financial Reporting Update webinar. My name is Elisa Noble, and I'm joined today by Moses Surfati. We're both from BDO's Technical Financial Reporting team. Due to the ongoing coronavirus restrictions, BDO continues to work from home. So please do bear with us if any technical issues arise during this live webinar. We will be recording the webinar, and that will go on our website, sent to you also by email, so you can always listen to that at a later date if we face any problems today. If you have any questions during the webinar, you can raise them using the question and answer function on your screens. If you raise any technological questions, especially to the host, then they can be answered as we present the webinar for you today. So what do we have on the agenda? Firstly, we'll begin with the latest financial reporting considerations arising from the coronavirus pandemic, which is likely to be important to many of you at this time. Secondly, as we're now approaching the June interim reporting season, we'll take a look at the changes to IFRS that are newly effective this year since 1st of January 2020, and which therefore need to be reflected in half-yearly reports. After that, we'll take a look at some other financial reporting news, as IFRS updates will tell you about the latest on IBOR reform and amendments to IFRS recently issued by the IASB. Finally, we'll finish the webinar with some UK GAAP updates. Okay. So where are we now with coronavirus-related financial reporting matters? Some of you will have listened to our last webinar on the 2nd of April, where we provided a summary of the financial reporting considerations arising from the coronavirus or COVID-19 shortly after lockdown was imposed in the UK, and after various initial statements with guidance and reliefs had been announced in order to support businesses through the crisis. A recording of that webinar is available on our website. So today we'll provide an update on developments since then and up to today's date, 18th of June. Given the unprecedented events of the last few months, it's inevitable that there have also been many developments in financial reporting, regulatory requirements, reliefs and guidance, as well as constantly evolving thoughts in response to the financial reporting questions being raised as companies account for and report on the effects of COVID-19 on their businesses. The effects can in many cases be pervasive, potentially affecting the valuation of multiple assets and liabilities on the balance sheet, the recognition and presentation of income and expenses, the going concern basis of accounting, and various disclosures. The issues stem from the uncertainty caused by COVID-19, the resulting increased level of judgment and estimation uncertainty, and how that may result in changes to measurements in the financial statements. Guidance has been issued by many parties, including BDO, regulators, and standard setters, including the FRC, ESMA, and the IASB. We've even had an IASB amendment to IFRS 16 for COVID-19 related rent concessions. That was developed and completed since we last spoke to you. So we'll take you through some of the key developments, guidance issued, frequently asked accounting questions, and the amendment to IFRS 16. Our focus will be on IFRS, but we'll also comment at times on UK GAAP accounting. So on this slide, in our last webinar, we presented a similar slide to this one with details about a number of legal and regulatory exemptions and relaxations that were put in place around the end of March. So an update on these is set out on this slide, and I'll mention a few of them because helpfully additional extensions have recently been announced for interim reports. So for now, all companies can continue to apply to Companies House for a 3-month filing extension. Note that legislation is currently in progress, which is also expected to address filing deadlines. We'll come back to that in just a moment. So for AIM-listed companies, temporary relaxations include a 3-month annual report filing deadline extension, which AIM companies do need to apply for from AIM regulation through through their nomads. And recently announced in June, there is also now a 1-month interim report filing deadline extension, which means AIM companies have 4 months to file their interim reports. The extension must be notified via RIS, and the nomad must also separately inform AIM regulations. For companies listed on the main market of the London Stock Exchange, a series of temporary measures are also in place, which include a 2-month extension to 6 months for the deadline to file annual accounts, and recently announced at the end of May a 1-month extension to 4 months for the deadline for companies within scope of DTR 4.2 to publish their interim accounts. So moving on to the next slide, which is about the government's, the BEI's response. So at the end of March, the Secretary of State announced that the government would, as soon as possible, bring forward legislation to assist those companies for which the restrictions of COVID-19 make it difficult to meet statutory obligations to do things like holding meetings, AGMs, and filing documentation on the company's register. Also to introduce some changes to insolvency law. While that legislation has been in the process of being developed, the FRC and BEIS jointly published a series of question and answer documents designed to provide companies with information to plan their activities over the coming months in respect of company filings and general meetings. This includes information about how AGMs might be held through closed meetings with a minimum number of people by way of telephone or other such means of communication. Details of all the various developments and Q&As can be found on the FRC website. Additionally, the government has also published a set of fact sheets explaining the measures in the Corporate Insolvency and Governance Bill 2020, which was laid before Parliament in May. That legislation will apply retrospectively from 26th of March and will be effective until the end of September 2020. So most of the changes are expected to be temporary. The key measures are addressed by the bill, and fact sheets are on the screen. And key things in relation to AGMs and filings include an ability to temporarily override some of the requirements that companies' articles may specify about the conduct of meetings, ability to postpone AGMs until the end of September, reduced attendees at AGMs, and an ability to hold them online, and generally enabling a greater use of electronic communication. Until the bill and any secondary legislation needed are fully effective, companies are advised to continue to apply to Companies House for the currently available filing extensions. The new legislation will also be making some important changes to insolvency law, including a relaxation of the wrongful trading rules. And as a reminder, if any directors are in doubt over their legal position regarding any of these matters, then they should be seeking legal advice. So with that, I am going to pass you over to Moses, who is going to be talking about the FRC's response.
Thank you, Lisa. So, as Lisa said, we're going to be looking over the next few slides at the FRC's response. And the FRC actually got off the mark quite early and provided guidance for companies in February on disclosures of risks and other reporting consequences arising from the emergence and spread of coronavirus. Then at the end of March, the FRC published more guidance on its high-level expectations for corporate governance and financial statements during COVID-19. The guidance covered 5 areas, which we actually covered in our last seminar, so we're not going to go into them today, but just as a reminder, they covered guidance on the strategic reports and viability statements, going concerns, significant judgments and estimation uncertainties, disclosure of events occurring after the reporting period, and they also had a reminder on the importance of dividends and capital maintenance, and that directors should take those responsibilities seriously. These areas are still relevant, as we talk today. However, this guidance was added to in May to incorporate interim reporting, disclosure of exceptional items and alternative performance measures, or APMs. And this is what we'll focus on today. Before we do that, it's worth noting the importance of high-quality narrative reporting in general, but more so in the context of COVID-19, where it could be argued that we are not in a business-as-usual situation, so disclosures that may have been taken for granted in the past may need to be looked at again. There have been a lot of changes to narrative reporting requirements recently, including the Section 172 statements for large companies, stakeholder reporting, including the directors' report disclosures on employee engagement, and for companies applying the 2018 Corporate Governance Code, more focus on reporting on matters such as emerging risks, corporate values, culture, and workforce matters. In our experience, in the current circumstances, these disclosures are very relevant to explaining the entity's approach to navigating through the crisis. For example, if you've been furloughing employees or not furloughing employees, you might want to discuss that in your narrative reports. Section 172 statements should focus on key decisions made by the board and link to other forward-looking information in the annual reports, including principal and emerging risks. So COVID-19 related matters will, in many cases, be a key topic to write about. In addition to that, the Financial Reporting Council's Financial Reporting Lab issued 2 publications this week with practical guidance and illustrative examples to help companies with reporting. One of them focuses on going concern risk and viability, while the other follows up on the infographics released earlier about key questions investors are currently focusing on about a company's resources, actions, and the future. I would recommend you have a read of those. They are quite an easy read, but they're quite informative and help set a scene for your thinking. So moving on to the recent update the FRC put out. They spoke about interim reports, and basically the emphasis was mainly on the director's responsibility to perform a robust assessment of going concern. It also suggests that additional disclosures may be required, including disclosure of any material uncertainties, assumptions made about the future path of COVID-19 and public health responses, the projected impact on business activities. Clearly, with all of these things, you'll need to include caveats, but the FRC are emphasizing the need to provide meaningful guidance to users of accounts. You may also want to talk about government support measures and the access to bank and other financing. In particular, if you have a refinancing due in the current year, while at the last time you reported, it might have been highly probable that this was going to be easy to negotiate. In the current circumstances, in the face of changing circumstances, that might not be as easy, and you ought to be updating the users of the accounts with that information. The FRC also notes that while there's no legal or regulatory requirement to have interim reports reviewed by the auditors or even audited, investors have indicated that they might welcome the additional assurance that a review or audit might bring. So again, it's something to think about. Is it worth engaging your auditors to perform a review of the interim financial statements? Also worth reminding about IAS 34 interim financial reporting. Now, IAS 34 is not compulsory for all listed entities. Only full list entities need to comply with it, but it does contain useful guidance, even if you're not required to comply. And in the context of that, your interim accounts, you may have in previous years omitted some disclosures because they weren't that relevant, or there wasn't a material change from the previous financial year. Again, in the current circumstances, you may have to consider giving more disclosures. Again, you would also want to explain events and transactions. Again, we're not in business as usual, so normally in interim accounts, you presume business as usual and don't comment on anything that's not out of the ordinary. Well, I think COVID is out of the ordinary, so you probably want to say a bit more about that. COVID may also have had an impact on changes in estimates. So again, the IAS 34 does say, well, if your estimate has changed since you last reported on it, you probably ought to say something about it. Similarly, impairment reviews, COVID could be considered to be a trigger for performing an impairment review, and we'll touch on that a bit more later on. But again, if whether or not you have had an impairment, you might want to discuss whether there was a trigger for impairment and how you assessed it. So if we move on to the next slide. So the FRC also added some guidance on exceptional items, and effectively they are saying, well, just because you've now got a cost that in the normal course of business would have had a matching revenue item, it's not appropriate to isolate that cost and call it exceptional. This is a cost that you would normally have incurred, so it's not exceptional. Also, if you've incurred more costs because of COVID-19, you may be able to disclose those as exceptional, but again, if there's an incremental revenue, so let's say you had to take on more staff because you moved away from, say, fulfilling from retail and onto online, so you've had to take more staff in your warehouse. You shouldn't just disclose the additional cost of that staff if you're not going to disclose the additional revenue that you may have generated as a result of that move. So again, they're trying to tell you to not just look at the debits, but also consider the credits. They're also discouraging splitting discrete items on an arbitrary basis in an attempt to quantify the portion relating to COVID-19. The justification there is that in the FRC's view, this is unlikely to provide users with reliable information. The FRC guidance also refers to alternative performance measures, or APMs. Their view is consistent with the ESMA, with an ESMA FAQ that's been issued as well, which we'll cover on the next slide. But the FRC are emphasizing that APMs that attempt to provide a measure of normalized profits, excluding the effect of the COVID-19 crisis, are likely to be, one, highly subjective, and therefore that makes them potentially unreliable. So they, again, are discouraging the use of additional APMs, which moves us smoothly on to the ESMA, or the European Securities and Markets Authority, who have issued a booklet of FAQs, or questions and answers, as it says there on the screen. And put it briefly, the ESMA acknowledged that preparers of accounts may wish to use APMs to communicate the financial performance of an entity, but they say that, well, they should only be used if they are going to help you provide a fair review of the performance of the business. And they then go on to say, well, if COVID is having a pervasive effect, a new or adjusted alternative performance measure may not be reliable, as the FRC said, and may be misleading to investors and users. So they are encouraging more and better narrative explanation as opposed to using additional alternative performance measures. So I think, again, there's an expectation that there'll be perhaps more words and fewer tables in sets of accounts that are describing the impact of COVID, because APMs would probably not be comparable, or in the worst case, potentially misleading. So if we now move on to financial reporting considerations, on the top left-hand corner of the slide here, you've got a few that we think are relevant. There will be others. So we've got the impairment of non-financial assets, IAS36. I mentioned before impairment triggers. Similarly, financial instruments. There will be some issues arising. One in terms of measuring expected credit losses on financial assets, but there may be other impacts of COVID-19. So if you're doing hedge accounting, you may have had a highly probable forecast transaction for which you entered into a hedging arrangement, let's say a forward contract to buy foreign currency. Well, that forecast transaction may be delayed or may not even happen at all, let's say if you're cancelling your orders from your overseas suppliers. So again, there's going to be some financial reporting impacts of that. We're not going to go into that one in too much detail. Measuring at its fair value, so if you revalue your, say, investment property, there may be just difficulties in assessing, what rents are going to be post-COVID. void periods may be longer. So there may be some challenges there in measuring fair value. Inventory, again, if you're a manufacturer, and we'll cover this in a bit more detail later. What are your normal costs? What are inefficiencies? How do you treat those? Depreciation of assets. Well, you may have assets eyeing idle. How do you account for that? And again, I'm not going to go into too much detail on the other three boxes because we'll touch on them. A key message is going to be always that when you prepare your financial statements at whatever date you prepare them, is to use the information that is known at the balance sheet date, and and if you're making forecasts or estimates, those have to be based on expectations that were reasonable and supportable at that date. And clearly, if at the balance sheet date there was one set of expectations, and then after the balance sheet date those expectations change, while you wouldn't be able, in most cases, to go back and revisit those estimations, you would probably want to disclose in your post-balance sheet events note that those estimations have changed and what the impact is if you have been able to quantify it. We've prepared a short booklet on which covers these areas and more, which can be accessed on our website or on our UK website or on our global website. So moving on. I think I've mentioned IAS 36 and impairment of assets more than once already, and I suppose maybe there's not too much to add on to what I've said already, but again, it's about an impairment test is about using forward-looking information and using expected values or expected cash flows. In the past, you may not have had too much variation in cash flows because you sort of could reasonably predict what those cash flows would be. Well, I suspect that in the current scenario there may be more variance of a set of cash flows that you may have, and you would have to give some weighting to some worst case scenarios which perhaps you wouldn't have done in the past because they weren't probable. So that's something to bear in mind, that you might need to expand your impairment model. Similarly with IFRS 9, and again, I think I mentioned most of these on my chat on the previous slide, so not too much to say, but clearly, again, because we're not in business as usual, a significant increase in credit risk. You may not have had those in the past, particularly as we've only been doing IFRS 9 for 2 years. So again, you might need to think a bit more about that, particularly if you're a supplier to a retailer. Well, we've heard of a few casualties already. You probably need to factor that in a bit more, and you may have. You may be moving your receivable from stage 1 to stage 2 or even stage 3. And again, I also mentioned hedge accounting. Again, that's something that is quite a complex area, but you may have either more ineffectiveness or failure of hedge accounting, or having to discontinue it. So again, something to look into. And again, we've got 2 more publications on this, on these specific matters. One on IAS 36 impairment on financial assets, and another one on financial instruments. I think I said financial assets, non-financial assets is IAS 36, and IFRS 9 on financial instruments. Again, these can be accessed on our website. So moving on to some specific questions. So depreciation, again, you've got a scenario here. You've got your asset being depreciated over 5 years to the residual value of 0, but it's now idle, maybe for the last 3 months, maybe even longer. Do you need to carry on depreciating your asset? And the standard, again, not necessarily written with COVID-19 in mind, but it states, depreciation does not cease when an asset becomes idle. So you have to carry on depreciating it. An exception to this might be if you are depreciating your asset on a production or units of production basis or something similar, where if you're not producing anything, then you don't depreciate. So the question then arises, should I be thinking about changing my policy to a usage or units of production basis? I think the answer we've given in most cases to that is probably not, because if units of production is a reliable measure, you probably also have been using it before. So assuming you had a good reason for not using it in the past, then potentially you shouldn't be adopting it. Again, you'd have to make that assessment on a case-by-case basis. One other thing to think about when you're thinking about your fixed assets or your PP&E is that the economic life may have been extended by this idle period, potentially, but also you might want to think about your residual value. What impact is this having on residual values? So if you're thinking about, second-hand cars, maybe those have gone, the values of those have gone down because there's now going to be more supply in the market. So again, things to think about on your depreciation and also on your fixed assets. So moving on to inventories, again, if you're a manufacturer, you may have either had to close manufacturing for a while, or even if you've been able to keep it open, you may be producing less because of COVID-19 related measures such as social distancing. So if you're producing fewer units than originally budgeted, are you allowed to capitalize into the cost of inventory your production line related costs as you normally would? And again, the answer to that, unfortunately, is no. Because the standard, again, states quite clearly that fixed production overheads are only allocated on the basis of normal production. So, you would say, well, what is, if my fixed production overheads are 100,000 and I produce 50,000 units, I'd normally apportion £2 per unit per unit produced. You still have to do that, even though this year you may only have produced 30,000 units. And the answer to this, and I probably should have mentioned it also on the last slide, is that the accounting is the same either under IFRS or UK GAAP. So moving on to some questions now on the furlough scheme and government support. So as you will probably know, the government is supporting staff wages up 80% of salary up to £2,500 per month, plus your NI and minimum pension contributions. Employers can voluntarily top up the government-funded amount. They don't have to, but they can. So how do you account for this or these scenarios? Because there's more than one accounting issue here. So in terms of the employment costs, and the way this works is that the employer will pay whatever they're going to pay the employee, and the government will pay the company back. So those employment costs, whatever it is you pay up, whether the 80% or the full amount, topped up amount, that you will treat as an expense as normal. The government funding is then treated as government grant income, and here we have a bit of a discrepancy between IFRS and UK GAAP. Under UK GAAP, the government contribution is presented gross in the P&L and on the balance sheet as in the P&L as some sort of other income, and also in the balance sheet. Whereas under IFRS in the P&L, you have the option of presenting net. So you would only show the costs of any topped up amounts under the net presentation. Now, in terms of the top up payments, so the question has been asked, well, can I? So let's say I've got an April year end, and I put my staff on furlough, but I was committed to making the top up payments for the next 3 months. Am I allowed to recognize a provision for those top-up payments for the period between April and June, shall we say? And the answer to that is no. Why is that? Well, I think there's various reasons. One of them is that the standards, and both under UK GAAP and IFRS, you're not allowed to provide for future operating costs, but also because this is a voluntary payment made by the company, it doesn't have to make it. So therefore, it's a choice that you're making as and when you make each payment. So in brief, you cannot provide for those top-up payments. So moving on to a question now that we see on revenue, variable consideration. So again, as you got there on the slide, a business grants and receives volume discounts on the sale of its products and purchase of raw material. As a result of COVID-19, then your volume of sales is now expected to be smaller, and similarly for your purchases. How do you deal with this in your revenue accounting? And again, just a reminder that, as always, your estimates of your revenue will have to are based on what are reasonable and supportable assumptions and conditions and expectations at the balance sheet date. But moving on to then, okay, so what do I do? In your inventory, let's say you normally do get those volume discounts, but now your forecast at the balance sheet date, let's say COVID has already hit, so you've now forecast that you won't get those buying volumes in. Then you'd have to basically factor that in and not bring in an expected discount into your valuation of inventory or your cost of sales. So again, you just would have to assume that you're not going to get the benefit of those. Similarly, with revenue, if you're not going to grant that volume discount, then potentially you may be able to recognize more revenue, albeit you'll be having lower volumes. But in respect of the unit sales that you do have, you might be able to recognize more revenue. Now, I think on revenue, it might perhaps be a bit more judgmental in that whilst you may not contractually be bound to give those discounts anymore because your customers aren't buying as much from you, you might consider that you are still going to give them those concessions. So again, if you are going to do that, then again you might still factor in those volume discounts in your estimation of revenue. Okay, so now we're going to move on to leases. This has been a particularly hot topic. We're seeing businesses getting rent concessions. Sometimes they're rent deferrals, sometimes they're holidays. And how do you account for those? So we're first going to deal with the UK GAAP answer. FRS 102 contains no specific guidance on rent deferrals or forgiveness. So the answer that we've got so far is that you will continue to straight line the lease expense. So even though you might not have the cash outflow, you won't reflect the benefit of a deferral in your P&L at the current time. If you, however, are lucky enough to get rent forgiveness, i.e. you don't have to pay the rent for these 3 months and it's not going to be collected in the future, then what you have to do is adjust your straight lining to factor in the future potential the payments. So what this means is that your straight lining will be now a lower figure than perhaps it was before, but again you don't get the full benefit of the credit or of that forgiveness in the period in question. It would be spread over the remaining term of the lease. So moving on to then the IFRS accounting, and I'm going to go through a little bit of a history lesson here, but IFRS 16, in contrast to its predecessor IAS 17, contains extensive guidance on how to account for modifications to lease payments that were not in the original lease terms. Some modifications are accounted for as separate leases, others require remeasurement of the lease liability by using a new incremental borrowing rate. In turn, any adjustment arising from a modification normally goes to the carrying amount of the right of use asset for a lessee. And when COVID broke out, there was a lot of clamor in terms of preparer saying, well, assessing whether a concession or modification granted by the lessor is a modification or not can be a laborious process, particularly if you're, say, a retailer and you've got lots of leases that you've got to pore over the detail to decide whether a modification that your lessor has given you is whether it is a modification or not for the purposes of accounting. So at first the IASB responded by issuing some educational guidance. However, this did not go far enough. So in May, the IASB issued an amendment to IFRS 16, which was expected to grant some relief. So moving on, we've now got on this slide. There's a new practical expedient which comes into effect for periods beginning on or after 1st of June 2020, and that's because that's the day after the IASB issued the guidance. It does adoption, and worth pointing out, and this is important, that this is still subject to EU endorsement. So if you are preparing and issuing your accounts before, let's say the full year accounts before EU endorsement of this amendment, you cannot apply it to your financial statements, but would need to apply the normal modification rules to it. For interims, there's a risk that securities regulators may not allow use of the expedient until endorsement. We're waiting for some clarity on that, but maybe the advice is to wait until endorsement happens before issuing your financial statements, but that may or may not be possible. So in terms of what the relief does, it gives a lessee optional relief from assessment of whether a change is a lease modification or not. It says, if you have a rent concession that was provided to you as a lessee as a direct consequence of COVID-19, then you do not need to assess whether it's a modification. You basically, and we'll come to that in a minute, but basically end up adjusting your lease liability for it. You end up with no adjustment for your lease asset, and you will get a credit in P&L for any reduction in the lease liability. This change needs to be applied to all lease contracts with similar characteristics and similar circumstances, so you can't necessarily pick and choose, although you may choose a category of leases to which you apply the expedient and a category of leases to which you don't. And again, assessing which category or how to put things in different categories is going to be slightly judgmental. Just to emphasize, if you're a lessor, there are no to the modification accounting in paragraph 87 of IFRS 16, which normally means an adjustment to the straight lining, as we described for a lessee under UK GAAP. So, what are the conditions? How do you decide whether you can use this expedient or not? So the three conditions. One is that the revised consideration is substantially the same or less than the original consideration immediately preceding the change. So again, if you've got a change whereby you get a reduction now but an increase later, and that increase is greater than what the payments would have been originally, then that would fall foul. The reduction in payments can only affect payments, so this is the second one. The reduction in payments can only affect payments originally due on or before 30th of June 2021. So if you've secured a long-term reduction, let's say that goes to the end of 2021, you're precluded from using this practical expedient. The third condition is that there are no substantive changes to other terms and conditions of the lease, e.g. if you've negotiated a lease extension, that would normally be that would be excluded. One thing to point out is that the IASB has said that if you have, let's say, a 3-month holiday, but then they tag on another 3 months to the end of the original lease with those payments, with the same payments as would have been in the same or similar payments as the ones that you're getting a holiday for, that would not fall foul of this requirement. So again, there may be some judgment that you need to apply to consider whether you meet or whether you tick this box. So in terms of accounting for this, I think I've touched on this briefly before. For forgiveness, let's say you get 3 months that you don't have to pay now or ever, then you will generally remeasure the remaining lease payments at the date of the modification. You're allowed to use the original incremental borrowing rate and any adjustment on the carrying value of your lease liability go to P&L. For deferrals, if you pay these 3 months, you're going to pay them over the next 5 years or the remaining term of the lease, but those you would remeasure the lease payments using the original incremental borrowing. If there's any difference to the carrying amount that you had before, you would take that to P&L. In terms of, there are already extensive disclosures required by IFRS 16, so about the net of leases. So if there have been any changes to your arrangements, you'd be expected to say so in your financial statements. They've added 2 disclosures that if you have made use of the practical expedient, that you say so and say which contracts it was applied to. So like I said, if you had a category of contracts you did apply to and the others you didn't, you would need to state that and recognize. You disclose the amounts you have recognized in profit and loss as a result of lease modifications for which you have taken the practical expedient. That takes me to the end of my section, and I'll hand you back to Elisa.
Thank you very much, Moses. That was hopefully a helpful summary of coronavirus considerations for all of you. So what we'll now do is take a look at what's new this year in terms of IFRS amendments effective for periods beginning on or after 1st of January 2020. So these will be particularly relevant for any June 2020 interim reports, as well as, of course, annual reports for affected dates. So moving on. So we don't have any new accounting standards effective for this period, but there have been 3 amendments to existing IFRS standards. So these are relatively small changes. We've talked about them in previous webinars, but we'll just remind you about the main points in the next few slides. The last item on the list is just about some updates to references to the IFRS conceptual framework, for which there is now a new version effective. So the first amendment that we've got on the screen here is for IFRS 3 business combinations, and that is to make a change to the definition of a business. So this is intended to help companies decide whether a business or a group of assets has been acquired, and it is likely to result in more acquisitions being accounted for as asset acquisitions. There are, of course, significant differences between the accounting treatment between a business combination or an asset acquisition to do with goodwill, contingent consideration, transaction costs, and deferred tax. So the new definition is on the screen, and it's important to note that this is narrower. So the emphasis now is that the output of a business is to provide goods and services to customers. Previously, the definition talked about cost reductions and other returns. To be considered a business, an acquisition must include as a minimum an input and a substantive process that together significantly contribute to the ability to create outputs. So you don't necessarily have to have outputs, and there's guidance and illustrative examples about how you would think about that for an early stage company that doesn't generate any revenue yet. There is new guidance, though, that if there are no outputs, then a substantive process will only be present if there is an organized workforce. So in addition, an optional concentration test has been introduced, which I'll show you on the next slide. I can change the slide. Okay, here we go. So the new concentration test is optional, and it's likely to be useful in more straightforward transactions where you might be able to avoid the need for a detailed assessment of whether a business or a group of assets has been acquired. So this could be, for example, for the acquisition of an investment property holding company, or maybe an early stage exploration or R&D type company. And how this test works is that it's met if substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset or group of similar assets. So that could be a single property or a single mining license or something like that. In that case, the transaction is not a business combination. No additional assessment is required, and you go on to account for that as an asset acquisition. The test will not tell you if you do have a business combination. So if you don't meet the test, then you must go on to perform the detailed assessment, looking at the inputs and the substantive processes, and see if a business combination is there. If the answer is no, then you may still end up with asset acquisition accounting. The test is based on gross assets, so you exclude things like cash and cash equivalents, deferred tax, and related goodwill. Okay, so that was the definition of a business. The next change is a more conceptual one, so a change to the definition of material, and this is just to help companies decide what to include in your accounts. I think we don't need to go into this in a lot of detail. The old and the new definitions are on the screen. You can see that there have been changes to things like could reasonably expected to influence. Users are now primary users. Both of those serve to narrow the definition of what could be material. And there is also now a concept of obscuring information, basically coming from the notion that important information should be prominent and well signposted in the accounts. Okay, the last amendment effective this year is to do with IBOR reform, interest rate benchmark reform, which we have talked about in a number of our recent webinars as this has been developed. So IBORs are interbank offered rates, and as a reminder, since the financial crisis, the long-term viability of IBORs has been called into question, and they're now being replaced with risk-free interest rates, a lot more based on transaction data. So this results in various accounting complexities because many companies have a lot of financial instruments based on IBOR. So the standard setters have been working on introducing relief to help companies through these issues. This is taking part in two phases, phase 1 and phase 2. So phase 1 is now complete and effective and available to be used, and this is to address pre-replacement of IBOR issues, specifically to do with hedge accounting due to the uncertainty in the run-up to when interest rate benchmarks are being changed. So there are a number of reliefs, and these will be relevant to you if you hedge account. There's also some additional disclosures there. We will come to phase 2 next as we move on to our other financial reporting news section to look at more recent things which are not yet effective. So back to the IBOR reform there. We now also have phase 2 because the IASB has issued an exposure draft for phase 2 in April. And this is to address accounting issues and complexities that come up in the post-replacement of IBOR period. So this is for things like modifications of financial assets when IBOR rates change in the contractual arrangements, as well as further hedge accounting relief needed because you could, again, as in phase 1, have problems with hedge accounting discontinuation as a result of the IBOR change. So phase 2 is at exposure draft stage. It's expected to be issued later this year and would be effective from January 2021. We don't know yet if the EU endorsement will happen before the end of this year, before the end of our transition period. If not, it will need endorsing by the new UK endorsement body. Okay, so On this slide, we had a few of the headings that are covered by those phase 2 amendments. But I think we're not going to go into those in detail. So moving on to another set of narrow scope amendments that were issued by the IASB in May. So they issued 4 things. The top 2 amendments we will cover on the next 2 slides. In addition to that, there were more updates to references to the conceptual framework and a package of annual improvements, which are small changes to 4 different standards on the screen. These will just be clarifications in nature, but you may want to take a look if you think you're affected by, for example, IAS 41. So what happened to IAS 16? So this amendment is to do with proceeds before intended use. So this prohibits a company from deducting from the cost of property, plant and equipment any amounts received from selling items produced while the company is still preparing the asset for its intended use. Instead, a company will now need to recognize such sales proceeds and related costs in profit or loss. So this will be especially relevant to the natural resources sector, where you're at the stage of transitioning from development assets to producing assets, and will potentially give a change of treatment for some companies. The treatment applies retrospectively, but only if to items brought to their intended use after the start of the earliest comparative period, where you make the adjustment to opening retained earnings. Okay, and that one was effective in 2022. EU endorsement has obviously not yet taken place. This will likely go to the UK endorsement as well. Second one, IAS 37, is to do with onerous contract provisions, and this specifies which costs you should consider when assessing if a contract is loss-making, which is potentially very relevant at this time, actually. So specifically, the cost of fulfilling the contract consists of both the incremental costs, so for example, direct labor and materials, as well as an allocation of other costs, for example, an allocation of a depreciation charge for using equipment, for equipment used to fulfill that contract. Previously, it wasn't clear whether you should include that sort of an allocation of costs or only the incremental ones. So this is likely to affect companies in many different sectors and potentially especially during the COVID circumstances. Okay. That brings us to our very last update, which is on UK GAAP. And here in May, the FRC released some amendments to UK GAAP as a result of the annual review of FRS 101 Reduced Disclosure Framework. These were just some minor amendments related to disclosure exemptions to do with the cash flow statement. They're available for accounts approved after 29th of May this year. At the same time, the FRC also issued FRED 74, which is for interest rate benchmark reform phase 2. And this is similar to what we've just talked about under IFRS, so addressing post-IBOR replacement related accounting issues with financial instruments, so modifications and hedge accounting again. Proposed effective date of January 2021 for that one. So that brings us to the end of our financial reporting update today. Thank you very much for joining us. We hope you found it useful, and we hope that you join us again. I'm just taking a very quick look if we've had any questions to be answered during the webinar. And I don't think we do. I think possibly there might have been some questions that are more appropriately answered by us after the webinar. So with that, thank you very much again for joining us, and do join us again.